Change leaders demand clarity and complexity. Leadership learning. On October 24th, 2001, Enron's board of directors dismissed Chief Financial Officer Andy Fastow after revelations that he had managed the LJM partnerships to conceal billions of dollars in company debt and losses. The dismissal came at a critical juncture. Just 8 days earlier, Enron had announced a staggering $618 million quarterly loss, triggering market shock and regulatory scrutiny. The LJM partnerships represented one of the most elaborate financial schemes in corporate history. Established ostensibly to manage risk, they allowed Enron to shift debt and underperforming assets off its books, creating an illusion of financial health, strength, and stability. These arrangements concealed the company's true condition from investors, regulators, and the public. As chief financial officer, Fastow owed fiduciary duties to Enron, yet he also managed the partnerships that traded with the company. This inherent conflict of interest enabled Fastow to personally enrich himself whilst orchestrating deals that temporarily propped up Enron's financial statements at the expense of long-term stability. The board later discovered that Fastow had earned over $30 million from managing these partnerships in just 2 years. The decision to remove Fastow was not a product of proactive governance, but the result of escalating external pressure. Several major banks warned Enron on October 24th that they would refuse further loans while Fastow remained in office. Credit rating agencies were simultaneously downgrading Enron's debt, threatening the company's ability to operate. The board accepted Chairman Kenneth Lay's recommendation and officially placed Fastow on leave of absence on October 25th, replacing him with Jeff McMahon. By this point, the damage was irreversible. The complex web of off-balance sheet partnerships had created interdependencies between Enron's stock price and the special purpose entities. As confidence eroded, this structure began collapsing upon itself. Within 2 months, on December 2nd, 2001, Enron filed for bankruptcy, marking the largest corporate failure in American history at that time. At the time, major credit rating agencies, including Moody's Investor Service, Standard & Poor's, and Fitch Ratings, continued to affirm Enron's investment-grade status, even as the company's financial integrity was rapidly deteriorating. Their misplaced confidence became another layer of the governance failure surrounding Enron's collapse. The Fastow dismissal stands as a watershed moment in corporate governance and financial regulation. It exposed fundamental weaknesses in corporate governance, particularly in how boards oversee management, conflicts of interest, and complex financial arrangements. The scandal revealed how sophisticated accounting mechanisms could be exploited to deceive stakeholders whilst enriching insiders. It demonstrated the catastrophic consequences when oversight bodies fail to ask difficult questions or challenge management assertions, even when warning signs accumulate. The reverberations extended far beyond Enron itself. The scandal contributed to the collapse of Arthur Andersen, one of the world's largest accounting firms, and prompted sweeping legislative reforms through the Sarbanes Oxley Act of 2002. It fundamentally altered expectations for corporate transparency, board independence, and executive accountability. The Fastow removal, whilst too late to save Enron, became a cautionary symbol of what happens when financial engineering replaces sound business fundamentals, and when governance mechanisms fail to protect stakeholder interests. Change leadership lessons. When complexity begins to obscure truth and accountability, effective change leaders recognize the moment to act decisively and restore transparency. Leaders of change demand clarity in complex arrangements rather than accepting sophisticated explanations that obscure fundamental risks and conflicts within organizations. They align compensation structures with long-term value creation instead of rewarding short-term results that enable personal enrichment through conflicted arrangements. Change leaders recognize that granting ethics waivers to executives establishes norms, legitimizing self-interest over fiduciary duty throughout the entire enterprise. They respond promptly to internal concerns rather than dismissing warnings that allow problems to metastasize beyond repair, requiring external crises. Leaders of change ensure transparency protects stakeholders by making complexity comprehensible, as camouflage for dysfunction undermines sound governance and sustainable integrity. Summary leadership quote: Change demands governance that questions complexity, aligns incentives with integrity, heeds early warnings, and ensures transparency protects rather than obscures organizational truth. Application, change leadership responsibility 3, intervene to ensure sustainable change. The Enron collapse illustrates the catastrophic consequences of leadership failing to intervene when complexity conceals corruption. Change leaders must act decisively when hidden risks threaten organizational integrity, ensuring transparency and accountability are not optional values but operational imperatives. Intervening to ensure sustainable change requires leaders to move beyond superficial compliance and confront the deeper structural and ethical weaknesses that enable dysfunction. This means strengthening governance systems to detect and address conflicts of interest, embedding transparent decision-making processes that clarify responsibility, and institutionalizing mechanisms that prevent the manipulation of information for personal gain. Modern organizations face similar risks when rapid growth, innovation, or performance pressure erodes ethical oversight. The responsibility to intervene demands moral courage, to challenge questionable practices, disrupt collusive cultures, and prevent integrity from being sacrificed to expediency. Leadership integrity is not a fashion. By acting early and decisively, change leaders transform intervention from crisis response to systemic renewal. Leaders of change should intervene to ensure that integrity, accountability, and ethical resilience become enduring capabilities that protect the organization, its people, and its purpose from internal decay and external collapse. Leadership of change. Final thoughts. In an era where artificial intelligence and organizational complexity often conceal risk, leaders must prioritize transparency and ethical resilience as safeguards against systemic failure. Sustainable success depends on embedding accountability within structures that ensure compliance and remain clear, adaptive, and principled. Those who intervene to ensure sustainable change transform complexity from a source of vulnerability into a foundation for enduring integrity. Find out more. Change Management Leadership, Leadership of Change Volume 4.